Do not trust here. In this video, I'm going to break down why governments are addicted to debt. All right, so let's get into it. So one, we have the crisis-driven borrowing, right? So major shocks, so including the 2008 financial crisis, COVID-19, and geopolitical conflicts have forced governments to act as economic stabilizers, increasing spending to mitigate recessions and social upheaval. These interventions, while necessary in the short term, have normalized deficit spending at crisis level scales. Next, we have low interest, rate environment, right? The era of quote unquote free money, near zero or negative interest rates post 2008 have made borrowing inexpensive, encouraging debt accumulation. For example, US 10-year Treasury yields fell from 4% in 2008 to near zero by 2020. Governments capitalized on cheap credit to fund infrastructure, welfare programs, and pandemic relief without immediate fiscal strain. There was political and social pressures that are involved in this as well, right? Demands for public services, aging populations, and defense spending like NATO targets create structural budget pressures. Tax hikes to cover these costs are politically unpopular, making borrowing a preferred alternative. We have inequality and debt dependency. So rising income inequality exacerbates the cycle. So wealthier entities like corporations, individuals, lend surplus capital to governments, while stagnant wages and reduced consumer spending force governments to borrow more to stimulate demand. Economist Atif Mian notes this creates a vicious cycle where debt sustains spending but deepens inequality. There are central bank policies, so quantitative easing and monetary interventions have enabled debt markets to absorb government bonds without immediate yield spikes. However, inflationary pressures and rising rates now increase debt servicing costs, exposing vulnerabilities. We have structural economic shifts, so weak GDP growth in many advanced economies limits tax revenue generation, while globalization and tax competition reduce fiscal flexibility. So, borrowing becomes a default tool to bridge gaps between revenue and expenditure. So here are the risks ahead, right? The bond market's tolerance is being tested as debt to GDP ratios approach 100% in many nations. So bond vigilantes, right, investors demanding higher yields for perceived fiscal recklessness, could trigger destabilizing sell-offs if deficits persist unchecked. So while some economists argue sovereign debt differs from household debt due to monetary sovereignty, Eurozone countries and emerging markets face acute constraints without full control over currency. Now, let's get into how government debt impacts economic growth. So there are threshold effects. So studies reveal a non-linear relationship. So moderate debt can stimulate growth through productive spending like infrastructure and education, but excessive debt undermines it, right? Research identifies a tipping point around 58% of GDP, beyond which additional percentage of debt reduces growth. This aligns with Reinhardt and Rogoff's findings of slower growth when debt exceeds 90% of GDP. There's crowding out private investment. So high debt raises long-term interest rates as governments compete for capital, reducing private sector borrowing and investment. So the Penn-Wharton budget model highlights how debt crowds out private capital formation, lowering GDP growth and tax revenues. We have fiscal distortion, so debt servicing costs divert resources from critical public investments. In the US, interest payments, which is about $881 billion in 2024, are projected to surpass defense spending by 2035, limiting funds for innovation, infrastructure, and social programs. Rising debt also increases pressure for future tax hikes, which can distort labor and investment decisions. We have policy and institutional mitigation, so strong institutions and sound economic policies like trade openness, efficient taxation, etc., can partially offset debt's negative effects. So, for example, Latin American nations improved growth in the early 2000s by reducing debt and enhancing policy quality. Conversely, weak governance exacerbates debt-related risks, right? We have financial stability risks. So uncertainty about debt sustainability can trigger precautionary behavior. Households save more, businesses delay investments, and creditors demand higher risk premiums. And this financial distress amplifies economic volatility and undermines growth. Regional variation, so emerging markets, right, face acute constraints due to limited monetary sovereignty and reliance on foreign dominated debt, right? And in regards to advanced economies, benefit from deeper capital markets but risk losing investor confidence if debt strategies diverge from growth, like the US debt to GDP nearing 100%, right? So now let's get into how does public debt influence inflation and deflation. So inflationary pressures from debt accumulation, right? There's the demand pull inflation. So high public debt often stems from increased government spending with, basically it injects liquidity into the economy. So this raises aggregate demand for goods and services, potentially outpacing supply and driving price increases. There's monetization risks. So if central banks finance debt by purchasing government bonds, quantitative easing, it expands the money supply, risking currency devaluation and inflation. However, modern practices often convert debt into interest-bearing reserves rather than directly, like the currency, issuance, right? Moderating this effect. So in regards to debt relief and, via inflation, unexpected inflation reduces the real value of fixed rate debt, acting as a soft default. For example, a permanent 1% increase in inflation could reduce the real value of US federal debt by 7% by 2051. This occurs because nominal debt obligations remain unchanged while rising prices erode their effective burden. Now we have deflationary risks from debt overhang. So debt deflation spiral, falling prices increase the real burden of debt, forcing borrowers to cut spending or default. This reduces economic activity, exacerbating price declines, which is a feedback loop observed during the Great Depression. We have tax code interactions. So deflation raises real tax burdens on capital income due to non-indexed provisions, discouraging investment and further depressing demand. Structural policy and dependencies, debt composition, countries with debt denominated in foreign currencies, common in emerging markets, face heightened inflation risks if currency devaluation occurs. The central bank credibility, well-anchored inflation expectations limit inflationary impacts of debt. Conversely, perceived fiscal irresponsibility may trigger bond vigilantes, demanding higher yields and tightening, financial conditions. We have taxation effects, right? So inflation increases nominal incomes, pushing taxpayers into higher brackets, the fiscal drag. This generates revenue but may suppress consumption and growth. Now, here are some empirical contradictions. So while theory suggests a positive debt inflation correlation, data shows weak or inverse relationships. For example, Japan's high debt coexists with low inflation, reflecting demographic, stagnation and deflationary pressures. So this divergence highlights the role of context. Debt's inflationary impact depends on whether borrowing funds, productive investments, are merely sustains consumption. So that's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. If you gained value from this video, if you were educated, you were entertained, and you want more videos like this, let me know that by hitting that subscribe button and the like button. Also letting me know your opinion in the comment section below. I appreciate your viewership. See you on the next video.